Well, hello everyone, and welcome to our YouTube live. And it'll be a pleasure to be speaking to you over the next hour. And maybe I should just start off by pointing out that we haven't reached 100,000 subscribers as I said we would 2 weeks ago. Hey, forecasts. Who's good at them? I'm not. So we should be there in 2 weeks' time, almost certainly. So thank you to those of you who have subscribed, and please tell your friends about us and subscribe. If you're watching this in replay or whether you're watching us live, it really helps us. And it's quite a watershed moment, so it's quite exciting for us. And I have been quite excited to see that actually clock over 100. So it'll be really annoying if it happens while I'm asleep. But hopefully we should be okay. And we should be conscious when it happens. Things that are going on this week. We've also... obviously, every week we produce a video explainer for our Patreon supporters. And this week it was kind of interesting. We're just about to publish it, but it's about central bank digital currencies. And it's not something I'd really looked at in much detail before, but it is very interesting. And I think there are certain things which it would allow, like negative interest rates, which simply aren't available at the moment, because if you've got cash, then you can always... you have effectively got a floor on interest rates at zero. So if interest rates go negative, then people can just hoard cash. And if they're hoarding cash, obviously the interest rate on that is never below zero. It's just zero. But if people have central bank digital currency instead of physical cash, then you can have negative interest rates. So you could effectively be taxed for having cash, which is kind of scary, I think, slightly sinister. I'm not sure that would wash well with the public, but still, that's another thing that could happen if we have central bank digital currency. Also, monetary policy would be quite different. So you'd also have the ability for the central bank to set an interest rate on cash, and that would set a lower floor. That would set the floor for interest rates on deposits with other institutions, because the lowest risk deposit, I guess, would be with the central bank, and everyone else would be higher than that. So yeah, interesting topic. Anyway, I think I might do a video on that on YouTube eventually, but not for a while, I don't think. Other stuff to mention: I'm doing a podcast interview tomorrow. I'm being interviewed on a podcast by an old buddy of mine who's Pete Matthews, who I met first of all when I was first marketing PensionCraft about 3 years ago. And he was the guy that said, don't put your videos on Vimeo, put them on YouTube. So it's thanks to him that you're watching me tonight. Anyway, so if you haven't heard it, it's very good. It's the Meaningful Money podcast. And I'll be on that. At least the interview will be tomorrow. And I guess it'll drop in a couple of weeks. Anyway, it'll be nice to talk to Pete. He's a financial advisor. He's based in Cornwall, and great guy. Really interesting stuff he does. His content is great. Anyway, so let's get on to the questions now. And I'll just have a quick look at Laura's Slack just to see if there's anything. Oh, yes, we've got a members tweet from Andrew O'Connell, a YouTube supporters tweet, sorry. YouTube supporters question from Andrew O'Connell, who says, hi, very confused about REITs. Those are real estate investment trusts, such as BBOX. Are you not just buying into an ever diluting set of dividends as more people buy shares? So let's have a quick look at that REIT, just so that we can see what we're talking about. So REIT, BBOX. This is the Tritax Big Box REIT. So let me just share my screen so you can see this. And then we'll talk through it. So this is the one that Andrew mentioned. So let's have a quick look to see what's in it. So what has it got? So it's a real estate specialist thing. So this is a storage REIT, real estate investment trust, and it delivers high quality and sustainable logistics buildings for our customers and attractive long-term returns for shareholders. and these are the companies for which it provides storage, Amazon, B&Q, so a lot of big retailers in the UK. And I guess, it's a fairly efficient way of funding that kind of infrastructure. And I wonder if they've got the annual... Yeah, here we go. So they've got full year results. Let's have a look at that. But basically the way this thing works is they will use capital which is provided to them by investors to buy real estate, and then they'll build these storage facilities for these companies, and then they'll effectively, I think, lease it out to those companies. But then the kind of role of a REIT is that it has to pass on that rental income from the companies which pay it rent to its shareholders, and it has to pay, I think, more than 90% of the income to the shareholders. And if it does that, then it doesn't have to pay corporation tax on its income. So from your point of view, it's a very tax efficient way to get your hands on corporate rent paying. So, people who commercial property rent, which passes to you as a shareholder. But it's an interesting question about dilution, because as more money flows into the real estate investment trust, the amount of properties or the number of properties which it can buy obviously goes up. Now, if it goes up enough, then it can buy more properties, and then that's why it doesn't dilute the actual generation of income. If the money was just stored as cash on the balance sheet of the REIT, then yeah, sure, that would dilute the income because the cash wouldn't be generating an income. But I think that's not the case. If they get more money, they're going to buy more properties, and that'll generate a high yield. So they're probably aiming for a certain yield threshold for any investments which they do. And I'm guessing that if it goes above a critical amount of cash that they've got from investors, they'll just build more properties and then rent them out. So I assume the property business can scale in that way, and that if they create infrastructure, people will use it. And it certainly seems to be the case that that's true for this sector. But it's always a risk, of course, that there aren't enough viable properties, or that the yield will fall gradually if there's not demand for a particular sector. So, for example, rent on retail parks. Physical retail isn't so popular anymore, particularly at the moment with COVID. And so perhaps that's a sector where the yields have gone down. And the occupancy rate has probably gone down on those kind of retail parks. So certainly for some sectors, I dare say, maybe office space as well, the yields have gone down. But certainly that doesn't seem to be the case for this sector. But that's how it works. Money comes through the door, they build infrastructure, they rent it out, and then the commercial rent comes through to you as a shareholder in proportion to the amount which you've invested. So let's see if we can see the actual dividend yield on this thing. So the payout ratio is very high. So it's in 2021, the payout ratio was 87%. So as income came in, 87% of it was passed on to shareholders. And on average, it has to be about 90%, I think, for it to qualify as a REIT. And has it got the dividends per share? So the dividends per share is £3.20. And I haven't got the price of the fund, otherwise we could work out the yield. So let's have a look on another system which I've got, which is share scope. So if we look for BBox, we should be able to get the yield. And this is BBox. And what's the dividend yield on that? Dividend yield is about 2.9% is the forecast. And I wonder if they've got the historic. I don't think they do. It does have ratios here. So the dividend yield currently, it's about 2.9%. based on trailing 4 quarters, so trailing 12 months. So yeah, about 2.93% is the dividend yield, plus you get capital gain if the value of the properties goes up, I expect. And obviously at the moment that's been going up a lot. So since the low in the big sell-off, let's just get rid of that. Let's do the percentage change. There'll be a fairly chunky capital gain, and that's 160% since the lows after the March sell-off last year. And if we look at the pre-COVID level, it's up 54%. So fairly good in terms of capital gain, and obviously the income helps. Generally, these things tend to be linked to GDP in the country where they're based. And if we look at the geographic distribution of the income for this fund, that should be in the summary, I think, or perhaps in company. No. Okay, it doesn't do a geographic breakdown, but I think this one is purely UK. So you can get geographically diversified REITs, and you can get particular sectors for REITs. There are all sorts of variations of the asset class, but that's the way it works, and that's the thing you'd be looking for: is how much income, how much capital gain, and is that sector in demand at the moment. Those are probably the things you'd look at. Interesting question though. Thank you, Andrew. So back to the questions. Okay, we've got another question from, we've got a super chat from AJ Bambino, who says, who's your favourite soccer team? Follow up, Man U or Liverpool, who you got? Okay, well actually I hate football, so I really don't have any strong feelings about that at all. But my family originally were from Birmingham, so I guess it would have to be Aston Villa, but I don't really support it at all. I don't watch it. I don't really watch sport at all, so I have to say pretty indifferent. Sorry about that, AJ Bambino. But yeah, I have been watching some of the Olympics, so I do have a kind of semi-interest in some sports. If I was forced to, I might watch tennis, but or rugby, but they were more fun. I mean, I enjoyed playing rugby; that was good fun, but not so much watching it. So let's move on. Stephen J says, another subscriber, I think. Yeah, YouTube supporter. So Stephen J, remember, if you want to have your question pushed to the front of the queue, either do a super chat, you have to pay a little bit for that, or support us on YouTube. Again, for the sake of about $5 a month, £5 a month. $3.99 a month, Laura says. You get your question pushed to the front of the queue. So if you do that, obviously it helps us too. It helps us. It helps feed my poor starving dog, who's Teddy. You're gonna have your see that treat. You could have paid for that treat. We should have sponsored treats for Teddy. Don't crunch too loudly, mate. You can see the rest of them on the desk. I might have to push him down. Right. So next question from Stephen J. With automation of trucks by 2030, I guess we're talking about the UK here, unemployment will skyrocket in developed markets. And UBI universal basic income might be used as old workers can't be re-educated as coders. You showed in a video that the Fed wants US unemployment at just below 4% and inflation hovering around 2%, the bullseye. But since automation and technological advances are coming, the US unemployment rate will skyrocket. Therefore, NIRU, the non-accelerating inflation rate of unemployment, doesn't really matter anymore to economic policies. When will the Fed accept this and raise interest rates accordingly? Some interesting points there. I think the first one is, I might take issue with that, which is that if truck drivers become unemployed, or I guess it's not just truck drivers, it would also be people like taxi drivers. I mean, if we do get fleets of self-driving cars, then you wouldn't need taxi drivers and taxis would become a lot cheaper, and an entire sector would no longer employ people. And of course it does employ quite a few people, but I think in terms of the entire employment in the UK or the US, truck drivers are actually a fairly small group, a very important group, obviously, because our food and our goods and services which get delivered by truck are very important to the lifeblood of an economy, to move stuff around. But still, in terms of the number of people it employs, I think it's fairly limited. I'd be surprised if it was more than about, say, 2-3% of the of the people who are employed, of workers, if that. So, is that going to be catastrophic for employment? Probably not. Could those people retrain in another job? It doesn't have to be coding. I'm sure there will be other jobs which those people can do. And I'd never underestimate the ability of people to retrain. People are very flexible, much more so than we think. And I think if somebody does lose their job as a driver, as a taxi driver, or as a truck driver, then there are many other things which they could do. It doesn't have to be coding. That would be quite a leap in terms of training required. But there are many other roles. Any other kind of driving job might be suitable, or other things which that person knows. So I really wouldn't think that people are that inflexible. And when I look back to the census, I think I've mentioned this before, a lot of the people I look back on my family tree and I look at some of the jobs that my ancestors did, it was things like bridle bit filer. So this is, horses have bridles, that goes in their mouth to steer the horse. The person who filed the bridle bit was what my great-great-grandfather did. Another one was a stationary engine driver, which was the name for somebody who runs a steam engine, or a kind of steam engine which operates as a press in a factory. Again, a job which no longer exists. But do I have a job? Yeah, I'm a YouTuber and I teach people how to invest. And it's almost unthinkable if we had to explain to our great-grandparents, great-great-grandparents, what it is that we do. Half of the jobs wouldn't make any sense. So you talk on moving pictures to people all over the world. Yeah, I mean, how would you explain that? Like Charlie Chaplin, I must be the Charlie Chaplin of finance. So it would make no sense to them. So I think people are very flexible, and I think the market is always evolving, including that for people who are looking for employment. So I'm not quite as pessimistic about you. Your point about NAIRU, the non-accelerating inflation rate of unemployment, is an interesting one. I think what the Fed is now saying in their language is they're looking for substantial improvement in the labour market. So all the talk about NAIRU has very much been toned down. I think they're kind of acknowledging that NAIRU is a kind of bullshit concept, that where even when unemployment reached 65-year lows, there was very little sign of inflation. And that suggests that the model's broken. Low unemployment doesn't lead to inflation, or at least it hasn't over the last decade. So I think what they're really looking for is a substantial increase in the number of people who are employed, or a substantial decrease in unemployment. How low should they go? Well, I think that's just a matter of judgment. Obviously, they'll be comparing the unemployment rate with where it was just before the pandemic hit, with a little bit of scarring thrown in probably. But when I do that, when I look at what full employment estimates are from the Congressional Budget Office in the US, I think it's going to take until 2025 until all of the scarring dissipates and we're able to, the Fed's able to raise interest rates. Of course, they can slow down the asset purchases before that happens. Slow down the MBS purchases, mortgage-backed securities and treasuries, which they're still buying at a pace of $120 billion a month. They can slow that down first, and then they'll talk about raising interest rates. And that'll probably be further down the road. But who knows? It might surprise us on the upside, and inflation might might start to creep up. Who knows? But I think I think the Fed will probably raise rates. My opinion, just extrapolating the numbers, I did a video about this a couple of weeks ago. If you just assume it's an exponential decay at the rate of the previous two or three recessions, I think it'll be until 2025 before they can really raise interest rates because of the scarring effects and the very slow. What happened was unemployment fell very rapidly. Why do we look at it? Actually, that's not a bad idea. So let's just look at the unemployment rate at Fred. Here we go. And I'll share my screen so you can see this. There we go. And this is the Fred time series for unemployment. And notice how it reached this level which hadn't been at since, 1965, I think, was when we were last at 3.4%, 3.5%. And then we got to this incredibly low level for unemployment just as the pandemic hit. I mean, it was tragic in a way because the unemployment rate was so low and people who hadn't been able to get jobs since the financial crisis were finally finding jobs. And a lot of minorities were affected by that. The black unemployment rate in the US is still very high, and generally it's much higher than the white unemployment rate. But then we had the pandemic. It spiked to over 14%, probably higher in practice. But notice what's happened recently is the quick wins have kind of gone, and it seems to have kind of slowed down the improvement. And in fact, the unemployment rate increased to 5.9% in June with the most recent print. So what it looks like is the quick wins are over, and now we're getting this slow recovery rate, which is what we saw in the previous two crises, where it takes about 4 years for the unemployment rate to halve. And if we apply that rate to that halving rate, the half-life, I'm a physicist, if we apply that half-life at the moment, my estimate is that we're going to take until July 2025 before we reach the CBO full employment rate. So I know that sounds a bit miserable, but the point is that they don't want to raise interest rates too soon because, okay, most people are back to work, but that's pretty cold comfort for the very large number of people, millions of people in America who haven't got a job. So the Fed has to take those into consideration too. We can't just think about white collar workers who tend to have high salaries which weren't affected as much. You have to think about everybody in society. At least that's the Fed's mandate. It's not just for rich people. Do you want another treat, Ted? Do you want another treat? Go on then.
Your screen.
We never leave a man behind. Sorry? They can see? That's all good.
Okay.
Okay. So let's go back to... oh, no, I'm not. You're right. You're absolutely right. Sorry, we'll have to feed you another treat, Ted. Come on. There we go. I have to see your beautiful face. Yes. Very good. Now this poor dog will starve unless we have some more super chats because I know, the super chats, Ted. That's what pays for the kibble and the treats. Yeah. I don't know. Some people not willing to pay for this poor dog to eat. There we go. So back to the questions. And minimize that again. And let's have a look. And I should probably say again, please do like our stream. It helps us a lot. And tell your friends about us. Subscribe to our channel. We're almost at 100k. It helps us if you do. And you can always support us on YouTube, and then we'll answer your questions at the front of the queue. Or super chat. Either's good. Next question from Arsenio Cornelio Penesi, whose name is very cool. I like that name. Hi Arsenio. Could you give your explanation of the Black-Scholes model of option prices? Oh, what fun. Do you have options in your portfolio? And are you still planning a course on options? Yes. Okay. So, yeah, I mean, I used to teach long courses, like week-long, 2-week-long courses on options for the sales desk at the bank I was working at. So, how would I summarize it? So let's say okay, first of all, let's talk about how you price a derivative. It's not what you think. It's not about maths. If you ask someone on the derivatives desk how they price an option, they may surprise you. It's very little to do with math. Well, the maths kind of helps actually, but the intuition behind the maths is actually very simple. For every single derivative which an investment bank sells, like call options, like put options, any option, or any derivative, the price that you pay as an investor is the hedging cost for the bank. So how does that work? So let's say you buy a call option from me, right? So that's an option to buy Apple stock at a fixed price at a fixed time in the future, if it's a European option. My position now is I'm short the option. So I've now got a position where if the share price goes up, I lose money. But I've got money in my hand today because you paid me a premium to buy the option. So I've got money in my hand, my option premium. I've got a very risky position because there's a fairly good chance the share price is going to go up. Otherwise you wouldn't have bought it. And I've got a big risk because if the share price does go up, I'll lose my premium and I'll lose my shirt, and so will the bank, because I've got unlimited downside because I'm short the option. So what do I do? Well, immediately what I'd do is I'd buy some stock, because if I'm short the stock, short Apple, you buy stock to exactly counteract my downside risk. How much would I buy? Well, it depends on how likely it is that the stock will end up at its expiry being in the money. So what I buy is proportional to the probability of ending up paying you money. So that's why there's something called delta, which is the moneyness of the option, which tells you really how likely it is that I'm going to have to pay you out money. So if we're just at the cusp where the option is just going into the money, there's a roughly 50-50 chance that I'll end up owing you money. So what I buy is half a stock, because that exactly counteracts my delta, which is the chance of having to pay out on the option. So I was short, but with my position on the call option, I go long with the stock, and now I'm hedged. But if the share price moves a little bit, what now happens is I'm no longer hedged. If the share price goes up, I have to buy more stock. No, if the share price goes up, I have to sell some stock. If the share price goes down, I have to buy more stock, because that's what the shape of a short call option position looks like once you hedge it. So what I'm actually charging you for the option premium is for my dynamic hedging strategy. And all options are priced that way. That's what the maths actually tells you. It's the hedging cost of the option. So what Black-Scholes is really doing is it's working out a kind of hedging formula such that if you dynamically hedge an option position based on the share price movements that you'd expect to see, then that gives you how much the option premium should be based on the hedging cost. So that's the way it works. And that's how Black-Scholes works. That's effectively what it is. So that's what the Black-Scholes option pricing. That's what the Black-Scholes option pricing formula effectively does. It kind of works out dynamically how much it costs to hedge. But then the maths itself is kind of elegant. And I mean, if I did do a course, I'd talk about the maths of it as well, because that's kind of fun too. There are a couple of ways to approach the maths of it. One is to build a kind of branching tree structure, which I think is quite intuitive. And another one is to do stochastic calculus, which I probably wouldn't mention, but which is pretty cool. There's a very good book about that, by the way. If you actually want to look at the maths of option pricing, this book is very good. I don't know if you can see that. Let me just see what I can see on the screen. Yeah, so this is Baxter and Rennie, Financial Calculus. It's quite a thin book, but it's very good, very well written, very simple way of understanding the calculus behind it. And there's another one which is quite good. I don't know if I can find it. It's John Cochrane's book. Oops, sorry, Ted. Just kicked my dog. John Cochrane. Where is it?
I could put the links in
No, here we go. So this is John Cochrane's book, How to Focus on Asset Pricing. Plus it's got a funky share or bond certificate at the front. Anyway, John Cochrane, brilliant stuff. He's also got a course, an online course about option pricing, which is really good. Plus there's one on option pricing plus there's one on fixed income, which is really good, where he talks about how to price fixed income derivatives, which is really interesting. Yeah, so anyway, there are a couple of good books, but they're quite mathematical. My book, I talk about options pricing, and it's called The Financial Bestiary. It's available on Amazon, but I don't use a very mathematical approach. I use these kind of intuitive approaches to pricing options and explain it in terms of hedging, which I think is more intuitive. And that's how people on the desk actually price these things in practice. It's the hedging strategy which tells you how to price them. Okay, next question is from Zishan, who says, I believe when at an investment bank, you used to advise high net worth individuals. That's right. Just curious to know the type of things you would discuss as a strategist to help them out. Also, which sectors do you see have upside at present? Oh, last point actually, Arsenio. Yes, I'm going to do the course. Currently, we're getting the website redesigned, and once that's complete, I'll be able to put courses on much more easily. So at the moment, I'm just going through the old courses, rewriting them in Elementor from Thrive themes. It's quite painful. But once that's done and the new website's launched, then I'll be able to do that. So I can write the new course. Plus, we might hire somebody to do that. So if you know anyone who is interested in working with us to develop courses and to write our weekly newsletter, tell them to get in touch. We haven't actually put out a formal job ad yet, but we're certainly thinking about it. But if you do know anyone, or if you're the person who wants to do that, that would be great if you get in touch. So Zishan, high net worth individuals, yes. What did we discuss? Well, obviously I can't talk about individual comments, but generally the kind of questions they were asking were about the question you're asking, which is which asset classes will do best in this environment. And of course I was a cross-asset strategist, so I was a macro strategist. So we talk about the bank's economic forecast, and then based on that economic forecast, we'd talk about different asset classes and also regional performance of the asset classes in each of the different regions for equity, for bonds. We talk about commodity prices, and we talk about our expectations for asset prices. So that's the kind of thing we did, and that's the kind of thing the high net worth individuals wanted to know from us. Obviously, they'd have other experts talk to them about things like tax planning or anything they were interested in, really. I mean, if they wanted to buy an art collection, the investment bank would help them go out and plan it. Or if they wanted to buy a vineyard, again, the bank would help them do that. So really, if you're high net worth, you can get people to help you do anything. But that was the kind of discussions that we used to have. It was about which asset classes would do best. Sometimes we talk about single stocks, but of course I was a cross-asset strategist, so I talk about it in the context of the macroeconomic backdrop for a particular sector. And one common question actually was, for example, if they were from I don't know, let's say they made their wealth with oil, then they'd want to discuss about diversifying away from oil. So how could they do that in a way that would still give them good returns? That kind of thing. So there'd be specific questions about their industry and how it would fit in with their portfolio, for example. And I still have those conversations now. So, for example, in PensionCraft, I had a high net worth individual talking about he was a very senior executive at an oil company, and he wanted to diversify away from oil. And I've had other people that were in the tech industry and they wanted to diversify away from tech. Some people from pharmaceuticals, which again wanted to diversify away. So it's often a case of building up expertise outside their own sector, because obviously within their own sector they were very expert. That doesn't always make you a good investor, I have to say, just because you know the sector, but it certainly makes you feel you know what you're doing. So that was the kind of thing we used to discuss. Which sectors do you have? Do you see have upside at the present? I think the commodity story still has further to play, and part of that is because we're still seeing an opening up globally. So I still think that oil prices have the ability to move higher. If we're looking at metals prices, many metals are still rising as demand increases, as people go back to normal life, and after the slump that we had the last year. So that's another thing. So materials as a sector. What else? I think the other kind of interesting thing is energy, but I think renewable energy is an interesting sector, but at the moment it's still very expensive. And what I'd like to do is to put that onto my crisis shopping list, so that if equity markets do tank, that's one of the funds which I'd buy, a thematic fund which gives me clean energy generation exposure. Another one would be self-driving cars or battery technology. So there are various ETFs that give you exposure to that, but currently they're very popular, so the prices are elevated. So that's another thing which I think is an interesting theme. Not really a sector, more of a theme, I'd say. And then other sectors, I think consumer discretionary, maybe that's got more upside. In the US that's very much dominated by Amazon, which obviously took a massive hit recently as it disappointed with the numbers. So yeah, maybe other stocks in that sector might be interesting, or Amazon itself, if it's sold off too much. So those are the kind of sectors which I think might be worth looking at, and the kind of themes I think which could be interesting to look at the moment. So I hope that answers your questions, Ishan. And actually, Arsenio, I didn't answer the other question, which is, do I have any options at the moment? No, I don't. No. I don't usually buy options. Right, so back to the questions. I don't think we've got any other questions from supporters, so I'll get on to the questions from everyone else. Here we go. So there's a question from Carlos Gallardo, who says, funds often have class plus a letter in their name. What are the implications? Does it matter which one you choose? Okay, so funds will have a letter following the fund name for the class of the fund. Usually there's a retail class, which is the one you'll buy. Sometimes there's another class for advisors to sell the fund, but still keep some of the income of the fund for themselves. So that's another way that these things get classified. So it really depends on the forum through which you buy the fund, which fee you pay. And some classes are to offer a discount for a given platform. So really, you'd be looking at the retail class usually, which is, I think, usually R, but it depends on the particular fund. I think it's confusing. I mean, that's one of the reasons why I like ETFs, because it's the same fee on every platform. There's no different share class. The only two differences are for ETFs is if you have an accumulation version where the dividends are reinvested, or an income version where you're paid the dividend. Those are the only two options. Sometimes they have a sterling hedged version as well, or a currency hedged version and a non-currency hedged. But those all make sense, whereas the classes I always find confusing and frankly annoying. Next question is from I kind of talked about sectors, but okay. Maria DC says, thank you for your great insight. My pleasure. Would you share what you have in your play portfolio and in your crash shopping list? Thank you. Okay, so the play portfolio, I use that to kind of try stuff out. So I've got a 3 times levered S&P 500 tracker from Wisdom Tree, because I'm just having a go with leverage just to see how toxic it is. So I never invest much in these kind of investments. I bought some MicroStrategy because I just thought they were crazy and I wanted some skin in the game, and I wanted to track MicroStrategy because they've spent so much on Bitcoin. They actually issued convertible bonds to buy more Bitcoin, and then the Bitcoin price tanked. So I think it's kind of interesting as a kamikaze company, but I just thought it would be interesting to buy some of that. I've got a VIX dynamic VIX tracker, so that buys futures on VIX, but it optimizes the term structure that it buys on the futures so that the roll cost isn't too expensive. That's always an issue with futures. If it's got an upward sloping futures curve, you don't want to buy the expensive stuff and sell the cheap stuff. So it kind of alters which bit of the futures curve it buys to minimize the roll cost. So I've got some of that. What else? Those are the ones I can think of. Yeah, I've got a long dated commodity one which is doing very well. When I made my video about the commodity super cycle, I think it was in March. That's when I bought it. Maybe it was February. That one's doing quite well. And there's a clean energy one. There's a healthcare innovation one. All of them passive. So that's what I've got, I think. But usually very small positions, and it's just for experimentation, really. Okay. Next question is from Alex. When there's been a crash greater than 20%, how long historically does it take to recover? Roughly, but ignoring the very quick recovery of the COVID crash in 2020. I actually did a video about this, so let me see if I can very quickly find it, and then I'll share the slide with you. Crash. I think this is the one. Yeah. So let's have a look at the probabilities here. Yeah, here we go. So let me share my screen. Okay. So this video was called, I can't remember what it was called, crash probability, something like that, probability of a crash. But this is drawdowns on the S&P 500. And I look at how long on average the drawdown duration is. And this is, by drawdown, what I'm talking about is you look at the latest peak, and a drawdown is when the share price stops falling and starts reversing. So, and then gets back to where it started. Now the median drawdown duration is just 61 days. That's because most of the time, if you look at these drawdowns for the S&P 500, so when it's blue here, that means that it's below the previous all-time high. The longest it was ever allowed, well, the longest that it ever fell for below its previous peak was 12.6 years. And that was after the dot-com bubble burst, because that was a double crisis. Just as the equity market was about to recover, we got the global financial crisis. So this one was actually 12.6 years. That's the longest it's ever been for the last 140 years or so for the S&P. The next longest one was, I guess it would be this double one again, after the Second World War and after the crash during the Great Depression in the US. So there was actually a triple period, I guess you could say. But unless there's a world war or another Great Depression, I wouldn't expect something that long. But you can see that most of the time what happens is the S&P just falls a little bit and then recovers very quickly. So if you're the kind of person that panics when it's fallen 20%, there's a very good chance that it'll just reverse on you and you'll be locked out of the market. So that's why I think, selling when equity markets fall is such a big mistake, because you don't know whether it's one of these, a quick dip, or whether it's one of these, a long dip, which takes a long time to recover from. And almost all of the time, it's a small dip, where it takes 61 days to recover on average as a median. So the other thing to look at is the actual probability of a crash. Even when equity markets are expensive, the probability of a crash of more than 30% is very low. It's around 5%. So that's when markets are expensive. When markets are cheap, it's even lower. So 1.4% probability within a 1 year period from now. So currently markets are kind of expensive. So there's a roughly 5% chance that we'll get a 30% or more drop within the next 12 months. But valuation is just a poor indicator of crash probability. I think that was the upshot of that video, which was kind of interesting, I thought. Okay, so back to the questions.
On Slack.
Oh, there's one on Slack. Two on Slack. So Stephen J is a supporter. Thank you for supporting us, Stephen. We really appreciate it as a YouTube supporter. Thank you. The USA is now one of the least fully vaccinated countries in the developed world, with just under 50% vaccinated. Do you think a new Delta wave and lockdowns are possible? Would this cause a market crash? Yeah, I think Australia is actually worse. So if we look at our world in data, it actually shows you the COVID vaccinations by country. I'll just have a quick look at that because it's interesting. So here is the actual vaccination, the share of people vaccinated. Canada's top, Spain's second, UK's third. And then if we get to the US, the share of people fully vaccinated is 50%, as you say, and partly vaccinated 8%, so that takes you to 58%. But you can see it's pretty good amongst developed countries. It's not far behind the rest, the countries at the top. If we go down to Australia, I think that was one that really shocked me. Where is it? Australia. It's actually not listed. So if we add Australia. So let's add Australia. Hopefully Australia is now on the list. And here it is. So Australia only partially vaccinated 18%, and in total 34%. So for a developed market country, it's behind Morocco, which is pretty shocking for a developed world country. Would it cause a crash in equity markets? I think probably not. And the reason for that is that the US simply wouldn't shut down. What's very clear is that for the US, there's very little appetite for closing down the economy or making the economy suffer for the sake of saving lives. But now that there is more vaccination, I think people are less likely to lock down. But really, if you live in the US, you've got more feeling for what the political waters are like. But it seems to me, just looking at US media, which I do a lot, that seems unlikely. Obviously, it's decided on a state-by-state basis, so different states will have a different approach. But I think it's unlikely that it's going to cause a crash for the market as a whole, because there is no nationwide lockdown. It'll probably be regional. And what we've seen in the US is usually it kind of spreads state by state. So southern states had a bad time for a long time. It really depends on how widespread it is and the impact it has. But I think it's unlikely to cause a crash. People are just buying the dip when it comes to COVID. People are just kind of conditioned to do that now because people see it as a temporary problem. And we are getting more immunity to the virus, and it's rapidly changing into something which becomes an endemic virus, like flu viruses every year. And in fact, the 1918 virus, which was so devastating when it was a novel virus, is now just a normal flu virus, which circulates every year. Obviously, it does kill people, but it's much less lethal than it was because so many of us have had it, and we have herd immunity to it, mostly. So I think that's what it's becoming. What is worrying is actually looking at the huge pool of people in the developing world who haven't been vaccinated. So, for example, if we look at very populous countries where there hasn't been a vaccine, so in Africa, if we look at South Africa, we look at Angola, Ghana, Kenya, with hardly any people vaccinated at all, that's just a kind of pool of people who will be effectively incubating variants of the virus. And I think this illustrates why healthcare really should be approached on a global basis, because we're not in a situation where we can isolate ourselves from the rest of the world. What's clear is that borders are porous when it comes to viruses like this. And if we don't look after everyone, we all get affected. So in a sense, it's taught us a good lesson, I think, in terms of global healthcare. But will it cause markets to crash? I think very unlikely. Very unlikely. Right, so back to the questions. I think we've got one more from a supporter, from Gary. Oh, Gary, hello, nice to see you again. Any thoughts on Chinese regulatory crackdown? Does it encourage or discourage the long-term investor in you? Has that gone live yet? It hasn't, has it?
No, it's Saturday.
Okay, so if you're a Patreon supporter, you've already seen my video about that. But does it worry discourage the long-term investor? I don't think so. What I would be worried about is variable interest entities, VIEs, because if you're a non-Chinese investor, not a citizen of China, and you want to buy Chinese stocks, you're not allowed to in certain sectors, like internet companies, for example, telecoms companies they're called, like Alibaba. So instead, you have to buy something via American Depository, so an ADR, an American Depository Receipt, I think it's called, or an American Depository Share, which is a share in one of these entities. But effectively, that gives you, so for example, if you buy an Alibaba ADS, it gives you a price which is in dollars. It trades on the New York Stock Exchange, and it's equivalent to buying 8 shares of Alibaba. But the plumbing that goes on behind the scenes, the legal plumbing, is incredibly complex and really based on untested law in China. And if China decides that these variable interest entities, which is how the linkage is done, if they decide those aren't legal, well, it's not clear whether you're going to have any money left in the bank from that stock. So that worries me. That really worries me. I think China would realize that would be catastrophic if they suddenly said these structures were illegal. They should have some kind of allow people to kind of gradually unwind their positions. But that's a worry. And if you look at stocks like KWeb, which give exposure to Chinese internet companies, it's an ETF by Crane Shares, that buys ADRs. So it gets its exposure by buying these variable interest entities. That's how it buys Chinese equity. So that would be hugely negatively affected if the Chinese government turns around and says, look, you can't You can't have these structures. And obviously the kind of mood at the moment between the US and China is getting colder all the time. And for example, the US has just sold some military hardware to Taiwan, which obviously will not be popular in Beijing. So, things aren't getting better in terms of relations between China and the US. So something like that is actually getting more likely that the Chinese would turn around and say, look, if you're a Chinese company, you're not going to be able to list on the New York Stock Exchange anymore. These variable interest entities are banned. And for education companies, that's exactly what they've done. They've said VIEs are no longer allowed. And that's why those companies have lost 60% of their value overnight. Also because the sector was declared as not being allowed to have a profit. That makes you really realize that when you invest in China, it's not equity friendly. Government policy will always win over shareholder value. Whereas in the US, you can bet that senators would fall over backwards in order to ensure that shareholders would be protected. So I think that's the real difference between investing in China and investing in the US or another developed market. It really is EM, and people forget that because the dialogue has always been about them opening up, becoming more transparent, and episodes like this make you realize, no, they're not. They're not a developed market. So yeah, that worries me about investing in EM, because if you look at any EM index, 50% of it, 40% of it will be China. So that worries me. And I do have some exposure via a global equity tracker, which I've got, because I only have 3 funds in my core portfolio, and one of them is a global equity one. And so I do have some China exposure with that, about 5%. So it wouldn't be catastrophic for me, but many of my clients have a big EM overweight, and I'd be worried for them. I'd be worried about the pension crafters who are in that position. But does it discourage the long-term investor? No. I think a lot of the arguments about diversification come to mind, but it doesn't discourage the long-term investor, no. Good question, though. Good question. Anyway, that video will be launched on Saturday.
Yes.
12 o'clock, 12 p.m. on Saturday. And that'll push us up to 100,000 subscribers, I'm sure. And Teddy will be able to eat. Oh, look, he's woken up. Yes. So hopefully, what do you think, Ted? 100,000 subscribers? Is it possible? I'm glad you can't smell his breath, by the way. It's not pleasant, is it, eh? Not pleasant. No. Has some bad habits. Right. Anyway, so we've got time for one more question. And let's see who that'll be. Okay, kind of interesting one about the housing market. Anton Belev says, how do you feel about the property market as someone who's renting? I am renting. This is a rented house. What are the factors that could make housing more affordable and bring prices under control? Well, certainly government policy in the UK is not helping, because I think they're still doing things like the stamp duty holiday, which hasn't been fully phased out. And really all that does is push up prices and pushes them out of reach of many people, which I think is a problem. I think they still haven't addressed the lack of supply. There's still an oligopoly where certain big companies dominate the market, and it's not in their interest to increase supply because that would lower prices. So I think there are many kind of vested interests, which it would be interesting if you could break them. I think a change of government in the UK would probably bring about a kind of political environment in which people would be willing to take on that oligopoly, but the Tory government certainly wouldn't. They still see housing as a big positive vote winner for them, which is why they have policies like reducing the stamp duty. But I think any kind of recession and an increase on unemployment, which we may well see now that the furlough schemes have finally being phased out, I think that would definitely have a negative impact on house prices as would very high inflation or increasing interest rates. Because if mortgages are less easily serviced, if people have to pay a higher interest rate, then banks will be less likely to lend. There'll be more foreclosures. Many people have taken out loans which they can't afford. And I think in the UK and elsewhere, that could well trigger a fairly unpleasant negative cycle for the housing market. But at the moment, it doesn't look like we're going to get a big increase in interest rates. So I really wouldn't panic about that at the moment. But personally, it would be nice if we got a better entry point and Laura and I could afford to buy a house. That'd be great, with a nice garden for Ted, yes, and a wood nearby. That would be great. I'd love that. And close to Laura's family, my family, that would all be great. But I think all of those things are unlikely to happen. I think this rally in the housing market will probably last a bit longer. But the furlough scheme ending, increased interest rates, I think those are the two which are most likely to make prices more reasonable. Anyway, we're 1 minute past. I said I'd finish by 8, so I will. And thank you all for joining us. Subscribe. Take us past 100,000. You could be the one that takes us past 100,000. And like us and subscribe to us. And we'll see you in 2 weeks' time after we cross that bridge. Anyway, have a great 2 weeks, everyone. Thank you for joining us, and speak to you then. And good luck with your portfolio.